Welcome to part 2 of our series on liabilities not typically included in net worth statements. We covered the tax liability in our first segment. Now, let's take a look at an important liability associated with retirement. When you retire, there is generally no longer a paycheck coming in to take care of monthly living expenses. If you're planning on a 25-year retirement, that is a lot of years of relying on personal savings or other resources. It is important to identify and quantify potential retirement expenses so we can plan accordingly. Now, Fidelity quantified one aspect of this liability several years ago. They estimated the average couple with a 25-year retirement would spend $250,000 for healthcare costs alone. That is after Medicare and before long-term care expenses, which I will touch on shortly. $250,000 is a big number, and it's our starting point for calculating living expenses in retirement. What are the other expenses? Well, one way to plan it is to take your current living expenses and adjust for them for the retirement years. Some adjust expenses based upon their expected levels of activity during the phases of retirement, such as the go-go years, the slow-go years, and then the no-go years. You might also adjust for preferences, such as leaving a legacy, traveling, and other major purchases. Since current projections suggest 70% of us will require long-term care, and since nursing home costs are increasing beyond $70,000 a year, we need to address this potential liability. Given its magnitude, transferring the risk to an insurance company will make the most sense for many of us. Today, there are many more options of addressing long-term care, but these options diminish as we get older. The total expected liability for taxes and living expenses during retirement is a big number, and it raises 3 important points. First, identifying and quantifying retirement expenses is absolutely necessary in order to have an adequate financial plan. Otherwise, there's no way of knowing if or when we might need to make a course correction. Secondly, given the size of your retirement liability, minimizing your lifetime tax liability is critical. After all, this is something we all have some measure of control over. Third, it's important to recognize retirement as a long-term liability that needs to be matched with a long-term investment strategy relative to your retirement assets. Said differently, you don't want to make knee-jerk reactions to short-term volatility with your retirement assets. In a future video, we will cover long-term strategies for retirement assets. If you have questions about your retirement and developing a strategy or financial plan, we would be honored to discuss it with you further.